Hello, good evening, and a very warm welcome to our next session of Powerhouse Series BFSI. Uh, we have today with us Mr. Muslim Raza. He is the head of treasury sales at Habib Metropolitan Bank. Muslim Raza is also our CFA partner for these specific to new topics, evaluating investment and financing decisions. These topics will be covered by Mr. Muslim Raza today and in the next session that will be held on Monday. So, without wasting any further time, I'll be handing it over to Mr. Muslim Raza. He will be providing a brief introduction of his achievements and about his role, and then we will be kicking off with our session. Over to you, Mr. Muslim Raza.
Thank you, Firoz, and thank you, ACCA, for this time and this opportunity. I think on behalf of, I'll start with thanking ACCA and the participants on behalf of the CFA Society. This is the first of its kind collaboration in Pakistan, where two professional bodies, and specifically the ACCA and the CFF, come together and started this roadmap. I've attended some of the other sessions as a attendee, and I think they were really insightful for me. So I thank you guys for that, and I believe we'll try on behalf of CFS Society, we'll try and make this today's session also an important one and something that makes each one of us have some key takeaways from this. As Thank you, Firoz, for your introduction. I'll just add certain things to my introduction. So primarily, I'm a treasury professional with around two decades of experience, typically with foreign banks all across ABN, Standard Chartered, and then Habib Metro at this point in time. I have looked at the country level roles for Pakistan and some East Africa markets. So those are the markets that I have experience of, and then some experience of working within Singapore and Malaysia. Other than that, I also am a visiting faculty at IBA and then continue to teach treasury and investment electives and strategic marketing at IBM. So with that, we'll move on to the topic at hand. Some basic guidelines, I think, which repeating to what Feroz and other sessions have worked out. So these slides at the end of the two sessions, I think Feroz and the team would be circulating it onwards as per the standard process. During the session that we'll have for 2 hours today and the next 2 hours on Monday. So the first 3 hours, I would be your moderator, and then I'll be your presenter, where we'll work through the theoretical and some practical aspects of the investment decisions and the financing decisions, and then look at how to move on and how to find something which is beneficial for all of us as market participants, and see how we can benefit from them. In the last 1 hour or 45 minutes of the session, we'll have one of our market participants join us, Ali Nawaz, for running us through the equity market as we speak, and give us a rundown on what the equity market is and how does the market looks like at this point in time. And all those funky questions that you may have of the market and why it is and where it is going to go, maybe you can direct it towards him. Of the 3.5 hours that I will be running through and moderating, what I think would be one of the better ones is that if we'll work through some of the theories at hand, and then some of the concepts at hand. And if there are any queries, you can drop in your queries in the chat box, and Feroz will pick it up, and we can then address them as we move on. Great. Moving on, the first thought that comes in is what are investments and what do we identify as investments or financing, and why are those decisions being looked at? Uh, Investments, as we look at, are typical long-term decisions that we want to look at, and we want to put our money away. We want to put our savings into those products, those financial securities, those asset classes, uh, and and the reason why we put them away is one good reason, and that one good reason is to have ourselves to have some positive real interest rates. IMF has also been saying a lot about Pakistan interest rates, and one of the things that they've been trying to push is a positive real interest rate in Pakistan. Dr. Raza Bakar, our previous governor, has been one of the most prominent proponents of positive real interest rate, and he had tried to rush that through and then drive our economy towards that. But we haven't reached that for a long period of time in history. Uh, if you look at positive real interest rates and nominal real rates and positive real rates, nominal rate, as we look at, is what we get in the market when we go out and invest and save our money. So a very basic example, if we can put at, if you're looking to buy an AC right now, and but we think that we have an investment opportunity, and the reason for that investment opportunity, or the thought process behind that investment opportunity, would be to forego consumption today, and not buy that AC, not buy that car, not buy that consumer durable or consumption item at this point in time, and save that money in an investment, in a financial product, in a product that we can put away. And the thought is that at the end of the investment tenure, maybe 1 year from now or 2 years from now, when we get our principal back, and plus the return on that principal. So the principal plus return should equal out, or should give us enough money that we should be able to go and buy out that foregone investment or foregone asset that we didn't consume on day one. So that's an investment business. Now looking at whether that investment return is what do we get? So, for example, we've foregone an AC consumption of 100,000 rupees at this point in time, and we invested it away for a year, and we had a 15% return on our investment product. So the net return that we get, or the net cash flow that we get after 1 year, is 115,000 rupees. Now the question that comes in, that's the nominal return. So 15,000 or 15% is the nominal return that we get. Now what we look at is that 15,000 rupees worth enough, or is it not worth enough going through that investment? So the key to look at would be whether that 15,000, when I go and after 1 year and go and buy that AC that I had foregone and not consumed a year back, and go and buy the AC today. So I buy the AC, for example, right now in the market the AC is worth 110,000 rupees. So from my investment, I'm getting 115,000 rupees, whereas I can now go and buy the AC for 110,000 rupees. So I get 5,000 rupees as my saving, which is actually my positive real rate, or positive real interest rate. And if in case the AC is worth 120,000 rupees, I get a negative real interest rate of 5,000 rupees. So the question that we're trying to do, or the thought process behind driving our business, would be to try and choose those investment decisions, and try and take those investment decisions where our real interest rate is, or our real return is actually positive, and we get more than what consumption we have foregone for this investment and for saving the money away. As we move into a little more professional and a little more complicated businesses and the opportunity, investment opportunity all across, and for organizations, uh, the key thing that works out is leverage. Leverage is something that we all are well aware of, and the thought process is using our scarce resources to benefit from the investment and to benefit from the opportunities that exist, and then doing more than what we have to ensure that at the end of the period we end up making more than what we've borrowed. So so investment and financing decisions in for an organization go hand in hand, which means that we will be borrowing or adding on to our scarce resources, building on our debt capacity and our equity investments, and doing business more than what money we have on our hand. And at the end of the day, we would be investing them or investing that amount of money into other avenues such that those avenues result in more cash flows for us. So as the topic is and as it is divided into, we'll try and break this down where our first few hours will be spent in looking at various investment decisions and investment routes and see how we can evaluate those investments. And then the fag end of this session will try and look at the financing decisions that are there and see how we can improve our financing opportunities and make it more cheaper. So the key to our business is, as it says always, is buy low and sell high, or maybe borrow low and invest higher. So the return that we would be looking at for our investments would be higher than the cost that we pay under our financing decisions. Now, looking at our investments, what are those investments that we can invest in? What are those securities? What are those asset classes that we can put our money in? So if we look at and if we go through our thought process and see which investment classes that where we can put our money in, one of the key investment class that we see is equity, which is investing our money into ownership of organizations which will conduct businesses and over time they will make some money. The money that will generally be made would be revenue minus their cost. And the body that I'm talking to are actually accountants, so I wouldn't go into the financial statements and how this is made. But the key thing that we will be looking at in equity is how much money either we're looking at the net operating profit that we have, or after tax or before tax, and try and work that out. So earning before taxes or net operating profit after taxes is something that we'll be looking at. Um, the key for an equity that works out is cash flows. I think you guys would have gone through the debate of accounting income versus cash flow, and the importance of having accounting income in our business, and how we can leverage accounting income. But the key thing that we need to understand for an organization to remain afloat is to have positive cash flow throughout, and avoid bankruptcy and remain solvent. So from equity, the other asset class that we can look at is a less risky class, which is interest rates or fixed income securities. As we look at, so we can have floating or fixed income investments that we can look at for our asset classes. Then from there, other asset classes that we can look at for investments are commodities and real estate. One of the key driving force in Pakistan, and one of the key investment asset class for Pakistan. And so these are the four key asset classes that we can look at, and then we can have hybrids and derivatives as another asset class that we can look at. Now, thinking of derivatives, what would derivatives be? Derivatives are typically financial assets. These are those assets whose value is actually dependent on multiple assets, multiple asset classes, either on commodities, either on real estate, either on interest rate, and either on equity, or a mix of them. And typically, one of the key driving factor or key pricing factor within derivatives would be the time value. And so the time when those cash flows are happening, and the riskiness of those cash flows, and the variability of those cash flows are dependent on time, and they're not sure. So that's a key thing in derivatives which you can look at. But that's an asset class that you evaluate your decisions on. When we look at asset classes, I would look at one of the thought processes that we've learned while understanding the investment landscape, is that any investment that we look at is generally a cash generating asset. Um, the exceptions to that would be some commodities which do not generate cash per se directly, or maybe some negative, even those assets which have negative assets or negative cash flows in the first few years are also negative cash generating assets. So any of those cash generating assets that we are looking at, the value of that cash generating asset would simply be driven by one element, and that one element would be the price or the thought process of the cash flows that it would have in the future, pricing that in and looking at those cash flows as we consider. And then on top of that, what we need to look at is how those cash flows would form in, and how those cash flows would generate. And then beyond that, we need to price them in. We need to bring their value to current, because the investment allocation that we're doing is now, and the return that we're getting is over time. These are two different cash flows, and over two different time periods. Uh, just like in maths, we can't divide, or we can't subtract, or we can't add cash flows over different periods. Uh, the key thing to understand is that the key thing to understand for cash flows is that when the cash flows are happening over two different periods, they can't be added or subtracted. They need to be brought at one point in time across the timeline, and then we can add or subtract them. The methodology, one of the key methodologies that you would have heard over time is NPV, net present value. And then when you look at the net present value, the key model that and any analyst would look at and price the securities would be using the DCF model. Uh, I see that. Am I audible? Because there's some conversation on me, my voice breaking.
I think your voice is perfectly fine.
Okay, great. Okay, great. So the key thing that we need to understand is the cash flows, the time period that when those cash flows are happening, and on top of that, we need to discount those cash flows into present value, and then look at their value today. So the key thought process is evaluating by the rule of the of present of this present worth of that organization. When you look at an investor, the investor is only looking at the value generated by the business for its cash that is there, which we as analysts or as financial managers also refer to as the intrinsic value. Uh, Intrinsic value of an organization, intrinsic value of an investment, intrinsic value of an asset is the future cash flow that organization would generate, and is that substantially over and above the current valuation of that security. Those are typical investors that we look at. One of the key participants in this market that we look at are speculators, or as the market calls them. When we look at speculators, who are speculators? Typically, speculators are people who would be buying a security not because of the intrinsic value that it would have, but morely primarily driven by the by the directional trade that would happen. Some would call technical analysts as speculators, and people who buy and sell securities based on the technical or the price movement and historic price movements rather than the fundamental underlying changes. So those are speculators that we look at, and but whether you look at investors or whether you look at speculators, both of them have to keep one thing in mind, that the security that we are looking at, the investment that we are looking at and pricing is that which has which is able to substantially generate more than the asset or more than the cash that we've invested in on day one, and the return that we get on top of that. When we look at the asset landscape that we have, we would see that there are some assets that we see in this market which do not generate cash at one point in time, or at time zero. Those assets include something like cryptocurrencies, or maybe painting, and so whether we look at painting, whether we look at arts, now if we look at a painting at some point in time will not generate cash at any point in time. But then why do we buy a painting? The typical reason for buying painting would be the fact that painting over time, when I sell at some point in time in the future, would generate more cash than what I've invested today. That's one of the thought processes. Or there is one more, when we look at non-cash generating assets like antique, or maybe some of those assets that add to our personal brand value, to our personal image and impression. Those are assets that do not have enough, that are not priced on the basis of cash or cash flow. So what are they priced on? The reason that the methodology to price them on would be the current demand and supply of those securities in the market, and typically how valuable or how illiquid that security would become, that investment would become over time. So that's how you look at. Then we've seen over the last few years a new asset class coming in, which are startups, or maybe some organizations which are high growth. Growth and value are two different investment categories. When you look at growth, growth are those investment categories or those investment securities where we continue to put in money at this point in time, and for the first few years they will not have positive cash outflows from the organization, but they would have they would require these investments would require money to be pumped into the business, and be and a constant investment over time. And then over a future course of time, these securities would revert back, and would have funds coming in, and then positive cash flows being generated. These are growth organizations. Or where if you remember your basic accounting or the accounting thought process, retention and retention ratios or payout ratio. So typically growth firms are those that have very low payouts and very high retentions, whereas value stocks are those which are in their business cycle, have actually achieved a level of investment where they are in their maturity, or nearing the maturity stage, and they will continue. At that point in time, they will be paying out high cash dividends, and their investment amounts at that point in time would not be would not be too much into the organization, and these would have cash flows coming out of the company. Now, when you look at these startups and then these high growth negative earning firms, the valuation that these firms depend on is more of a fashion, a fad, and rather than actual cash flow valuations. And also these firms would then be valued on various other thought processes. Like for startups, one of the key things that you value is how quick, or what is their client adoption rate, and how many clients are joining in, or how many consumers are starting, how many new clients that they can take on. For another key thought process for valuing startups is the burn rate. The burn rate means that the investment that the company has, or the cash flow that the company has in terms of its asset, what is the rate that they are burning their day one capital availability. And the slower their burn rate is, and the higher the client adoption rate is, the valuation of the company becomes higher. And looks at that is how you look at and price an organization, which is now intrinsic value. If I go back 15 years or 10 years back in the market, there were key stocks, or the blue chip stocks that were always being traded by the investors, and there were certain stocks that were not being traded, or being picked up by the investors, because the volume or the liquidity in those assets was substantially lower. So the research analyst community, the investor community, or the new blood that came in, started looking at those organizations, and started looking at how the value or the cash flow of those organizations are being generated. And using the cash flow methodology, and using the value, these investors were able to cover and find out some hidden assets, and they'll have rallied to their to the current prices where they are. One of the key things that you look at is price to book value. That's a multiple that you look at. So when we talk about market multiple, we'll look at how you try and look at those multiples and prices. Typically, the thought process of an intrinsic value is doing a financial time travel. The thought process behind the time travel is that you're trying to move forward over the life of the business and the organization, and trying to judge how those cash flows of your business will fall through, and when would they fall through. The using that the key thing that would work out is whether those securities are undervalued or overvalued. Again, a very basic thought process is that of undervaluation and overvaluation, and you buy a stock at when it's undervalued, which is that the market price is less than its intrinsic value that it is being traded at, while which means that the cash flow or the cash outflow that you have right now will be lower than the future cash flows that you have in present value terms. Whereas overvaluation means that the outflow that you would have to do on that security to purchase that right now would be substantially higher than the future predicted cash flows of that investment, and again in present value terms. EKG. So what do we do when we're making these cash flow judgments? We're trying to make a judgment in the magnitude how the cash flow changes over time, and as the cash flow changes over time, one of the key things that change the valuation of the cash flow, and it changes the payback of the security of the investment amount that we have over time. Similarly, one of the reasons why two different analysts would have, or two different financial investors or financial judgment people would have different pricing of the security at this point in time, would be their view on the timing of the cash flow, and when would that time come in, and then when you differentiate, and when you have the same cash flow coming in at different point in time, or maybe even at same point in time, one of the key things that you need to decide as an investor is what discount rate to apply. What is the rate that you need to bring that security to value today, and which in financial terms we refer to as the weighted average cost of capital. For any equity valuations, these two, which is cash flow and timing, are key understandings that we need to understand, and key to judgments that we have. These two key judgments are developed while looking at the economic situation that the environment and the country has, the conditions that we look at over time of how the economic landscape, how the specific standalone risk of the company would change, the business environment or the systematic risk, and how those systematic risks would change over time. Then one of the key things on top of that is the riskiness, the beta of the company that you're looking at, and the judgment in the riskiness of the cash flows. While you can maybe give a crystal ball, or maybe a methodology to determine and to review the cash flow and the timing of those cash flows, and two investors may have, or two evaluators may have clarity, or may have a judgment on the cash flow timing and the cash flow amount, but for sure the riskiness of that company and the riskiness of that cash flow will not be same for any two investors or any two people in the market. And the primary reason for that riskiness is driven by the Jory window, or the perspective that each investor has of the company, and the cash flow and the organization and the business risk at that point in time. So no two people looking at the same picture will have the same result. And since no two people will have the same result and the same view and the same opinion, the riskiness profiling of the two people will be of that cash flow will certainly be different. And then one more thing that we need to understand, that each one of us have our own preferred habitat. Uh, uh, in financial terms, when we talk about habitat, that's an area where you and I prefer to do. While we all believe, and we all want to believe that we all are rational beings, and we tend to take decisions based on real ground things that are happening. But if we really look at how investors are, and the reality behind the various investment decisions, we will see that most of the investors that we have in the that we see are not rational. They have their own reasons to be irrational. They have their own reasons to take decisions based on their current situation and how the market flows. So therefore, which actually impacts the judgment of each individual. The riskiness of cash flows, and the riskiness of the company, and the riskiness of the business environment, and the systematic risk of the market is both a key judgment call in both equity and bond markets. If I try and sum it up, the fixed income market is a market where where we're trying is an eliminating game. The game, or the thought process in a fixed income market is where it is you try and not be wrong. We try and find the best one, and then the route of doing that is eliminating high risk, high low cash flow guaranteed investments where the return is lower. Whereas in equity, the problem is that none of these cash flows or the timings are well stated. They're not written down, and they're not guaranteed. So in equity, the game, or the thought process is finding the right investment, and finding the best possible outcome. Uh, Anything and everything in the financial markets is primarily driven by information. When we look at information, there are two key the key method to look at information, or how we divide information, is based on its private and public nature, and then material and immateriality. Uh, so the dangerous place to be is where when you have private and material information, and then this is a place which falls under insider trading, and whether we talk about ACCA or CFA, all of these bodies are very careful, and we all are very careful not to go down this ethics, and our ethos require us to stay away from this place, because this takes away from an efficient market. Um, any immaterial information, whether it's public or private, will generally not have will not have a price impact. So because it's immaterial, so generally it's not there. Uh, Now what happens is that some investors uh, may not be able to capture or read or understand and price the public material information, and then incorporate that in current market prices. And when that's a fair game, because if some investors are unaware uh, of a public material information, and therefore is not pricing it, or is pricing it differently, and that's when the price difference, or that is when one investor is selling the security and the other investor is buying the security, and then trades would effectively not be happening in an efficient market, because everyone would have priced in and incorporated all the available information that is there in the market. So efficient market is that we try and look at, but one of the key things that we need to ensure, that all material information is publicly available and is there for everyone to access. If there are any queries, we can look at. Otherwise, we move onwards. Okay. So, looking at the investment, the landscape, the two key thought processes that are there in any investment landscape is looking at the sorry. Looking at and valuation thought process is to look at how the company generates its free cash flows and breaking it down and maybe discounting it by the key thought process of the weighted average cost of capital. When we look at the free cash flows, the thought process is that we pick up sales revenue. Uh, Sales revenue are sales revenue is something that drives or is the blood is the blood on which the organization thrives. Whereas the operating cost and taxes are the outflows that happen to make that engine running and make their sales engine generating our day-to-day inflows uh, on to make those sales and operating cost and the engine running. There are certain investments that need to be made in the in the organization and in the operating system in the cash flows that are there. So when you look at all three of them, that is when you get what is termed as the free cash flow of an organization. And then you look at how those free cash flows would move and would be generated over years, over year one, over year two, over year three, and then the game is to bring those free cash flows to today value and see how those cash flows would be worth today. And then the valuation that we get, we need to compare that with the initial cost. Now, looking at the weighted average cost of capital, this is one of the key important decisions for an organization, and this is where the financing area would fall in. The weighted average cost of capital, the two key source of capital for an organization is it's either its debt or its equity. So one of the key things that an organization needs to look at is whether what mix as an investor, as a business person, we need to keep for our debt and equity. The debt equity mix is actually something that drives and that runs the organization and will actually result in a make and break for the firm. Uh, because this is where the leverage will come in. An equity investment or an equity mix in the of the organization does not require. If you have equity in the organization, the equity of the organization does not require a guaranteed constant outflow. But when you look at debt, the debt portion that is there is actually a dead weight. So what do I mean by a debt weight? Because you have constant outflow that you need to make when you have debt in the organization. You can't run away from those. You can't delay those cash flows. Uh, Whereas equity holders are, as we all know, the residual claim holders for an organization. Another thing that we need to understand is another thing that we need to understand is the business risk of the organization. Uh, the riskiness as a manager of the company, uh, what we need to do or what we need to ensure is that we minimize the investor's view of the company's risk or the business risk that is there. How do we do that? Is by showing our investors, showing the people who are investing in our organizations uh, more clarity on the cash flows and more clarity on the timing of the cash flow and more security on it. Uh, so if we go back 2 slides back and we look at the judgment calls, as soon as what the a perceived risk of the firm is lower when there is more surety and there is more clarity on how those cash flows will fall through. Whereas when in an organization there is more unclear thought process. There is more unclarity on how or when the cash flows will come in or why those cash flows will come in. The perceived business risk of the business, of the organization, of the investment increases. As an investor, the unclear that I am, I will demand a higher return from it, and my weighted average cost of capital would rise. As a business participant, I need to, as a business owner, as somebody who's a manager of the organization, I need to try and drive and reduce the business risk of the organization. Uh, we need to understand when we are managers of the organization, one of the things that we need to understand is that the market or the investors are typically risk averse. They try and avoid volatility in their returns. They try and avoid unclarity in timings of the cash flow. They try and so an investor would prefer generally lower return over unclear return. That's how the market typically says. But then there are certain clients which and there are certain investors which prefer volatile returns and volatile investments rather than sure returns, because as it is volatile, the required rate of return or the hurdle rate that we talk about is substantially higher. Then one of the key things that we'll need to look at is the market rate, because those are the base rates that will set everything. Um, these are the rates that an investor can access and can get without doing much of an activity, and these are typically guaranteed returns that flow through. So as the market interest rates are higher and as they move up, the riskiness of the entire investment proposition that we have becomes more and more higher, and that's when we become that's when we need to look at a more higher return. That's when we look at more defaults coming in into the into our system. For banks, we see more NPLs coming through. For equity investments, we see dividend being reduced and value stocks being converted into growth stocks or decreasing their payouts, because what they need to do is they need to help and they need to retain their cash flow, so the retention ratio goes up and the payout ratios reduces as interest rates go up. um, if you look at Pakistan right now, we're going through a period of high uncertainty. We're going through a period of high risk aversion. One of the things that we've seen right now in Pakistan is that investors have pulled themselves back. So people prefer right now to be cash rich rather than investors in this market. So that perspective have actually pushed the perceived risk of the firm higher, and as that perceived risk of the firm has been pushed higher, the weighted average cost of capital demanded by the investor is being pushed higher, and therefore the valuations that we see right now in the market which we'll be talking about in our next session, when we look at how the equity market stands right now, we'll see that the valuations right now looks in a historic perspective at the lowest. The multiples are at their lowest, and the equity market looks really attractive. But despite it looking attractive right now, our investment community is staying away from it, and the reason that they are staying away from it is the risk aversion part, where they do not know that how long or how dry this spell, how long and how dry the spell of delayed cash flows of an organization would be. And as the cash flows get delayed, the current value of the security becomes smaller, or the perceived cash flows. The perceived timing of the cash flow as it gets pushed onwards, the current valuation or the PV of the investment becomes smaller and smaller. And as that is pushed forward, one of the key things that we need to understand is that the valuation needs to be looked at as the current initial cost that we are, or the outlay of the investment, and based on that outlay, based on that outlay, the security is either undervalued or overvalued. Therefore, as we see right now, there is a risk aversion and a sell-off in the market, both in real estate, whether both in real estate market, in commodity market, in the equity market. If globally we see oil for the last few days have been very volatile and moving up and down. If we look at oil and commodity price movements, one of the key risks that has been that played out in the commodity and the oil market right now is how the China demand and supply would move, how Russia-Ukraine war would affect the supply of natural gas and oil to Europe, and how that supply chain would create a recession across Europe or recession across the US, because cost of doing business is substantially going higher. Uh, while the cost has not gone up, maybe, and it is just a future thought process of how of whether the war will drag into winters or not, and if it drags into winter, then how the business, how whether the Europe and the US space would be able to get the heating gases, and how much money would they have to divert from their day-to-day consumption and their investments and their and their and their consumer durables buyout, to buying out the necessities and the essentials in the business, in their day-to-day life, which is into heating and food and day-to-day communication. As that happens, and as the move happens, the scared resource will move from investments to basic consumption, and based on that, we see a perceived higher recession in the international market. So any questions still here?
Not yet, Miss Muslim.
Great. So the key thing that we need to look at is typically the valuation techniques. The two key valuation techniques that we price in, or we work out in our international system, is either looking at multiples or looking at discounted cash flow. We'll first look at discounted cash flows in our business thought process, and then we'll move to market multiples and see how market multiples work as the discounted cash flow. The key thing that we need to look at is the terminal value, which is typically the biggest value that we have or a security has. What is the terminal value? When you look at a security, there are certain known cash flows and there are certain unknown cash flows in of a security. As you look at the known cash flows, we will for a certain organization, there won't be any known cash flows per se, because we all will need to make those judgments about the known cash flows that are there coming in future years. Uh, we will only be able to predict cash flows for some years, 2 years, 3 years, 5 years, 10 years, as clarity we have from our business and our investment and our security holders, and the management that comes out and discloses that. What we need to understand is, and what will be missing in those security investment will be, after a certain period there would be obscure cash flows, and those will be summed up into terminal value. And again, terminal value, when we look at terminal value, we would be picking up as market multiple methodology. The key judgments that we need to make on the cash flows, or in a DCF method, is that the first thing that we need to look at is economic judgments on how the country, how the economy, how the business, how the environment will function for a security, for an investment, and how would that affect. So for a cement company that's operating in Pakistan, businesses that are situated in north versus businesses that are situated in south now have a substantial risk due to floods. So while maybe some years back we would have said that, or maybe 6 months back we would have said that the Karachi business and those plants situated in Punjab, they would both be able to access the port and be able to ship. But now, if we look at floods, what have they caused? The land route is stuck. There are a lot of transport. Heavy transport vehicles that are stuck in the middle, and maybe because of that, a lot of ports, port raw material and port of finished goods are not moving into Punjab, and then similarly, exportable surplus in Punjab is not reaching the Karachi ports for onwards shipments. So that has created valuation differential between those plants, or those two entities, which are situated in each side or each respective provinces. Similarly, the quantum of devastation that has happened, plants that are near to the devastated area, or where those growth will happen, or where those rehabilitation efforts will be applied. So those plants that are near those rehabilitating areas will have a higher sale, will have a higher offtake, versus plants that are situated away from these flood affected areas. So these judgments called these economic business future judgments could not be seen 1 year back or 6 months back. Nobody would have thought that there would be floods coming in. So that those judgments create uncertainty in the future cash flows. Similarly, when we look at growth rates, each organization, each company that we look at will grow at a different rate. what you and I see as the growth rate would be different than what the actual growth rate would pan out. Then the one of the key problems, or one of the key errors that flow through in looking at discounted cash flow methods is the weighted average cost of capital. When we look at the weighted average cost of capital, the errors that come through is that what would be the future rates, how recession, how inflation would fall through. Looking at 2 years back, nobody would have expected the Russia-Ukraine fallout, and what has happened in Russia-Ukraine would potentially maybe impact the wheat production across the globe. And if this continues for another 3 to 6 months, we may see a famine curve hitting, and wheat may not be available for as a staple food, because Ukraine is actually one-third supplier of wheat. If you go back 2 years back or 3 years back, nobody would have been focusing on Ukraine for the importance that it generates with respect to wheat supply to the global market. So these unclarity on how things would be, and how the interest rates would pan out. If you look at 1 year back, most of us were looking at single digit interest rates, and in Pakistan, and none of us were saying that we would see so quick double digit interest rates coming into play. Whether we look at exchange rate, the constant devaluation of exchange rate over time, we this was something, even if we were looking at 2 months, just we go back, and when the IMF sign off wasn't done, every single individual was of the thought process, as soon as the IMF sign off would be done, we would see exchange rate maybe down to below 200. And right now we still see we are back standing at 240 in the interbank market. So there those judgment calls have to be made, and there are a lot of errors in making those judgment calls. Based on what we see, and the errors that we make, there will be a lot of consistency issues that may come in. When I say consistency issue, what do I mean? My thought on consistency issues are, or consistency errors are, that I need to apply my economic and my growth rate and my discount rate and my exchange rate and my assumptions into each and every area and equally. But as we go on to applying, and we look at the account receivable, and we forecast the account payable, and we forecast the interest rates, and we forecast the exchange rate, um, um, but these key inputs for accounts payable would change when I go into the account receivable area, because I would be more focused on and more positive on how my sales would come through. And I may miss out on applying the recession element, higher interest rates, while I may on my account payable apply a higher interest rate, and then say my borrowings, my short-term borrowing will be higher. The cash outlay required in interest for my borrowings would be higher. Why? Because interest rates would be higher. But when I go back onto applying and looking at account receivables, and inventory, I would have I would talk about sales as being, I would be very proactive and very positive in predicting sales, and how the company would grow. And I may miss out, uh, and have inconsistency in applying those higher interest rates, because potentially that higher interest rates would create recession in the economy, and would reduce my sales. But as we move on, and one thing that continues to fly through on our mandate, on our task at hand, is that information, and finding the right information and looking at the right information is the key to drive any valuation, and pricing that information into our business would create the right cash flow. Market multiples, that is the key driving methodology that we see in the market. The thought process behind market multiples is that sorry, the key thought process behind market multiples is to try and compare, and as we talked about some time back, that the key focus in equities is to find the best possible investment, and it's a process of not negative elimination but positive elimination, and finding which is the best one. So it's a comparison methodology where we are looking at to pick up an investment which is cheapest at that point in time, at this point in time, and has the ability to give and ability to provide an upside for my investments, and with the higher investments to have. So one of the matrices that we evaluate or we look at is the price to earning ratio of an organization. The price to earning ratio is very simply looked at, is looking at the current price of that security in the market, and looking at the earnings that are predicted, future earnings that are predicted of the company. And the simple is, divide the price to earnings, and whichever is the cheapest available for that earning, we will pick that up and process that as a business model. Then one of the key things that we look at is the enterprise value to earnings. What does enterprise value to earning means? Is the enterprise this is the key book value, or how the enterprise is worth versus how much earnings will it generate over time. So that's how the organization or the market multiple work, and the fallacy of the market multiple methodology is substantially higher than on the DCF methods, because the key behind the key behind market multiples, or is that the market, or the people out there are rational, and they are efficient. So we are operating, the key underlying assumption for market multiples to work is that the economy, or the investment and the market is efficient. If the market is efficient, then the market multiples would certainly price in every information, and then it logically makes sense that for the same earning by an organization, and if something is cheaper in price for the same rupee value being generated at the same point in time, you pick up one that is more cheaper, because the potential of this security or this investment rising is substantially higher than the other one. Or on the flip side, we may want to invest in a security, and the game plan is, or it's more of a protective hedge, and then the thought process is that the fall in price of a lower PE organization would be lower and lesser than the fall in price of the other one. So if I have to be invested by a certain portion in equities, the better option is to look at a PE ratio which is lower. The key thought process behind DCFs and market multiples is the ability of the investors to create assumptions about the future, and it's like looking into the crystal ball. If you and I can look into the crystal ball and have a logical view, and the better crystal ball that we have, the better forecast we do. DCF is one of the most conventional methodologies that we do. It's substantially superior because it allows you to list all the forecast, all the assumptions that you have, and then it's not something which is hidden, and then none of the assumptions are obscure. So you put all the assumptions threadbare. You can, and then anyone who's checking and who's evaluating, or who wants to look through the pricing model, can actually investigate and tweak the relevant forecast, and get to a model which gets you to which gets you to the current pricing. And on top of that, if you want to change any assumption based on how the market changes, we can always look at it and change the assumptions, and get to our valuation. Uh, we've already talked about the fact that in DCF, pricing those organizations that are startups, or pricing an organization that don't have cash flows on day one becomes a challenge, because the cash flows are negative, or there we have to find other ways and methodologies to look at. And then therefore valuing startups is more of a comparative methodology rather than an absolute science. So startups can be valued, or these tech organizations are generally valued via comparative methodologies of multiples. When we look at multiples, while one of the easiest ways to price securities, and most widely used, and accepted by the general public, one of the things that we need to understand when we look at multiples is that it compounds the judgment error, because it supports, or it generally tends to drive a herd mentality within the investor classes, and it assumes that every security, or the basic security that you're comparing to, and the market that you're comparing to, is actually it is at its equilibrium. And when this is at its equilibrium, what happens that when things are at its equilibrium, the assumption is that securities will be they are at their equilibrium, and therefore the security price is perfect. Or the market is pricing the entire market perfectly, and when the entire market is assumed to be perfect, then you say that this security is cheaper. But it could be that some of the key assumptions could have been missed by market, or market asset allocations could have been placed somewhere else, and based on those asset allocations, the pricing of that security may not be fair. Then one other thing that we need to keep in mind when we look at investments and securities, that every security and every investment have different life cycles. Uh, and as we understand the business life cycles, when a company is in its setup stage, the cash flow required, or the burn rate of that cash flow, or the survival rate of that investment of that organization is substantially lower than the other one. Uh, I'll put myself at mute because there's a to just give me 1 minute. There's some protocol going, so a lot of noise here. Just give me 1 minute. Apologies. So I'm back. Uh, so business life cycle. We're talking about business life cycle, and as an organization, we look at the business when it's in its infancy stage. The business requires a lot of cash flow to be pumped in, and future cash flows would be substantially higher. Similarly, when it's in its maturity stage, the company becomes a cash cow, and it tends to generate funds and cash for the businesses, and therefore the thought process of looking at those cash flows, and the funds coming in are substantially there. So multiple methods. When you look at the market multiple method, the error, or the life cycle of businesses is actually missed out and ignored. And therefore this may create errors in valuing companies, where you cannot differentiate between the two investment securities and investment classes. So that brings us from an evaluation methodology or an investment decision that tends to sum up the theory that we have, and the conceptual thought processes that we have. In the next, we'll move on to the financing routes if there are no other questions on the floor, and in the next one we will try and have some sort of a case that we'll run through, and we'll see to evaluate how we can look at a company and evaluate those thought processes. Looking at the financing routes. So for a company, hello, am I audible?
Yes, you are.
Okay. Okay. Sorry, Firoz, you're saying there is a question or something that you'd like to take first before we move on?
We have a question from a participant, but if you want to conclude, if you want to conclude what you're currently explaining, we can take that after. We can take the question after that.
No, I think if it's related to investment, we can take that up, and then we move into the financing route. So it's good if we have some.
Okay. There's a question from Umair Ahmed, and he wants to know why still the investors tend to subscribe to market multiple method for making investments.
Okay. Umair, the key reason that we may that's a very good thought process. So I will refer to my community as being lazy and finding and hiding behind or believing in the collective judgment being stronger than the individual judgment. So when you look at the market multiple method, the market multiple method typically bases base itself on the fact that there is a security which is priced in, and the market average market is there. So rather than trying to beat or trying to reinvent the wheel, what the investing community wants to do is actually what the investor community wants to do, or the research analysts want to do, is actually beat the average or be stronger than the or be driving a valuation of the security which is better than the average. So I need to find a security which is, from a multiple point of view or from a comparative point of view, cheaper than the other securities in the market. Unless I have some information for the security or for the market or for the specific asset class that I'm looking at, or for the specific sector that I'm investing in, unless I have some very specific questions or specific information available wherein I can change the cash flows available or the timing available, I would tend to subscribe to the price calculated by someone else and by the analyst. And then another thing to keep in mind is that pricing a security is not or predicting cash flows is not a very simplistic task. It is a lot of effort that goes into pricing securities and looking at how things would be. We all believe in delegated pricing, rather than going and pricing ourselves, pricing the security ourselves first. Second, you and I, when we look at as the investment community, most of the investment community that we have, other than large investors, are actually are people who are passive investors, and they rely on experts to actually price the security, and give them the judgment on the security. If we look at the so when we look at ourselves and when we look at passive investors, the passive investors prefer the active investors to have priced the security and to have put all the cash flows in and made those models. And then therefore market multiple works at as an easier methodology to pick on.
Thank you, Mr. Muslim, for your answer. I believe there aren't any questions for now, so we can move on to our topic that we were discussing. In the meantime, I'll ask all the participants to please type in your questions so I can present those to Mr. Muslim.
Okay. The key routes. Let's do a very quick look down on the financing routes available for funding our investments. Uh, we'll focus on the internal funding route for today, and then we will break it down here, and then we'll leave the others for our next class, for our next session, webinar hour. So a business which is self-generating cash flows. Working capital is one of the key places or the key sources of generating positive cash flows for an organization. Uh, so what you look at is when you look at when you look at the organization, uh, the focus for an invest for a customer for a sorry for a management within sitting inside the organization would be to ensure that the organization is liquid. um, when we look at liquid from an accounting point of view, liquidity is being able to service your own debts and your own liabilities and your own cash flow commitments at all point in time. uh, while those cash flow commitments are there, the investments that those that are required in account receivable, the in inventory, in our accounts payable, by looking at trade discounts or some other methodologies, actually cause cash flow or liquidity crunch on our business. And the key thing that we need to do is to ensure that we manage our cash flows and we manage our liquidity. Um, the, the the simplistic method of managing our liquidity is matching. What is matching as a thought process? The thought process work out. The 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 thought of managing matching is that if I have funds coming in at a certain point in time, or I look at I look at where my funds would be deployed, and where I need to settle and match it out. And so my short-term investments and my short-term borrowings would ensure that they match out the cash flows, such that on a day-to-day basis I do not have too much remaining in my ideal in my ideal in ideal in my accounts, in my cash flows. And this is more of a passive investment strategy. If you look at mismatching, the mismatching is a the mismatching strategy is actually an active strategy in the market. And this mismatching is where you actually leverage and you build a curve, and you try and make money out of make money out of your various short-term investments. um, the problem with mismatching or maybe leveraging as an investment strategy is that it takes the focus away of an organization from what it is made to do. So, for example, a textile firm has to be more focused on running the textile farm and managing its inventory and managing its sales and managing its supplies, and looking at where capex and BMR it needs to do. But instead of doing that, what the management or maybe the employees will be focused on is how they can leverage between short-term borrowing, then short-term investments or long-term investments, and mismanaging the curve. And when you try and ride the interest rate curve, while yes, it is something that that it's easier to make money on, but there are but the challenge that comes in is that when you have this mismatch, it causes your focus to be lost, and then you're focused on making money not from your core business, but from your investments strategy. uh, you've you've all looked at and read in your books the account receivable, and how you manage by receivable management and receivable financing, and looking at discounting and rediscounting of cash flows. Sadly, in Pakistan, we haven't had a substantial market go through for receivable financing or trade financing per se. for on our local sales. Certainly, banks do look at trade financing, especially on the export side, but I think there needs to be a lot of focus that needs to come in from the financial institutions on receivable financing, on vendor financing, on maybe creating SPVs for the cash flows that come in, and channeling them into sinking funds and moving them onwards. The game is to ensure that that our account receivables are the life cycle or the cash cycle is smallest, which means that our account receivable days are smaller, and then extending our account payables, and pay them at the latest possible, at the last possible time. Or maybe if you want to pay early, then maybe we want to take discounts, and the trade discount should be evaluated on how we look at the current interest rates and the nominal and the risk-free return, risk-free rates in the market at this point in time. Uh, so things that have played out well, and I think where the market has worked well, the financial markets have worked well, is looking at inventory management and pricing those inventory management policies, and the economic EOQs, the GITs, and looking at obsolescence and managing obsolescence has been some place that a lot of work has been done, and I think that's an area that would now change, because of the fact that when we were kids, we were talking about just in time, and we never thought that these shipment delays would come through, and things will vanish from the markets, and it will become difficult to get hold of them. But now, inventory warehousing, and holding on to your inventory, and holding on to materials such that your supply chain is not affected and your business keeps on running on a day-to-day method, on a day-to-day basis, it has become more and more important, and as such, inventory management, I think, would take some steps back, and then from JIT and EOQ, and maybe move back to putting in some extra funds more diverting some investments and funds from business and capital capex to inventory. So with that, we will pause here, and we'll take some questions that are there, and we will move on from there.
Thank you, Mr. Muslim. There's a question from Masood Ahmed Fayaz, and he is asking, what is the risk-free rate of return in Pakistan nowadays?
Thank you, Masood. A very pertinent question for this point in time. Risk-free rate, when you look at one of the most bookish definition for a risk-free rate, is to look at where the current T-bill and where the current security is right now. And if I look at the government rates for anywhere between 3 months to 1 year, the risk-free rate that you may look at is actually it would be around 15%. And then if I go into the long-term category, the risk-free rates would be around 13 to 14% in 3 years time, and maybe longer. For a longer investment, the risk-free rate would turn out to be 15 to 12 to 13%. So we are right now are seeing an inverted curve at this point in time, inverted investment curve at this point in time, and then we will see how things flow through. Uh, but but one of the key things that we need to understand from this point in time is that currently the investors in Pakistan are actually facing a negative real rate and substantially negative real rate, which means that if I look at in Pakistan, the inflation, the CPI is around 24-25%. The SPI is around 40% in Pakistan. So when I look at those numbers, the investment return, the risk-free return, and actually the investment return right now are substantially lower. What is that causing? So how does that impact on pen out for Pakistan, Masood? The challenge that we see is that uh, a lot of investors are preferring not to invest. The second thing that we are seeing is that businesses, due to this rising interest rate cost, rising inventory prices, the thing that is happening is that the impact that is doing on the business is that it is pulling your cash flow availability from investments and capex into inventory management, because of the overall slowdown in the business. A lot of account receivables that was coming through are being delayed, and people are actually requiring account payables to be done quicker. Because of all of this, the actual actual discount rate to be used for pricing a security has substantially moved up from the risk-free rate. While the nominal risk-free rate stays at 15, or for a 1 year investment, the real risk-free rate is substantially higher and would be somewhere around 25%, and therefore the returns are substantially lower.
Thank you, Mr. Muslim. Another question from Amir Rame. SMEs face difficulties in calculating their value and to translate those calculations to potential investors. Any advice and comments on this?
Very good question. This would go for both SMEs and startups, and those. So one of the challenge for Pakistan is that our SME space are small. The funding has not actually gone down to our SMEs. That is a real challenge to the Pakistan sector for the last so many years, and this is the key reason why growth at grassroots levels have not come in through. Um, we can blame the investors at it, but I would more want to blame or put the onus of responsibility on the owners of the SME. uh, Now, what the SME owners can do to shoulder this responsibility. So the key thing that I think the SME should do is, first of all, maintain a clear book of accounts. The SME investors, typically there is always a management account which is substantially different. Um, um, and we all know, and another problem with Pakistan is that we have a substantial undocumented economy. I wouldn't call that black economy. I would call that undocumented economy, because the business activities are substantially all clean and clear. But it is just that we fear documentation, and we fear putting that onto our records and onto our books. So the management accounts that we have don't have a clear trail of cash flows. So one thing that SMEs can do is create a clean trail of cash flows, moving in both for their sales and moving in for for their cost of goods sold and supplies that they've bought, or the raw materials that they've bought. Then the second thing that I think the SME owners need to focus on is actually translating their thought process or their business vision into a process note or a business case, which the evaluators or which the investors can actually look at. So I think one of the so that's a space that the investors are really not very comfortable with, because it's not well written. So maybe write your story well, and present it well, so that the timings of your cash flows, the timing, the quantum of those cash flows are very clear to the investment community, to the people who are investing money into the business. So those are the two things I think the SME owners can do. Similarly, I think the investment community, uh, or the people who have those cash flows, I think they also need to sit down and spend time with these with the SMEs. And lending these people is not an easy piece, but the potential returns and the upside in the SME business and the cottage industry, and investing in this area is substantially higher. I think I am without any political affiliations. I have none. So I think there was some good there was some good policy actions taken by the previous governor, state bank governor, and driving those activities. But I think we what missed out was the pace and then the economic liaising that with the economic situation on ground, and then I think we missed that out. So SME directed government policies should be there, and and that would, I think, simplify the SME space. Jifros.
Thank you. Uh, Another question from Umair Ahmed. Currently, all capex evaluations are quite impossible to evaluate. What are your comments that how a company in current scenario calculate its hurdle rate, since current discount rate is not sustainable and will reduce in near future? Which factors should we take into account while adjusting the hurdle rate?
Okay. Umair, your question has a opinion expressed in it, which may not be aligned to my opinion. So it actually highlights the thought process of which I have been saying, that so you believe that the interest rates will fall. I may think that there is more room for interest rates to rise from here, and hence. There will be a buy sell opportunity here that I see, and then there's an investment and a disinvestment opportunity. Okay. So your thoughts are on the capex evaluation, and the hurdle rate for weighted for the WACC that we use. See, so the thing that we need to do, or what one need to model out, is how inflation would pan out in the forward. So key things that you can look at is how inflation would be there. How do you see the price of various commodities or the key inputs to move in? Um, that's one thing that that you need to account for. The second thing that you need to account for is how the commodity price super cycle will flow through. would the commodity super cycle burst here, or there is more room for the commodity super cycle to continue? That's another thing that you should look at. The third thing that we need to being inward looking into Pakistan, one of the things that we need to be very conscious of at this point in time is how our exchange rates would pan out, and what our balance of payment situation would be, because any impact and any changes in the exchange rate would actually impact our inflation via the imported inflation route, because a substantial portion other than even oil is of our SPI and our CPI is an imported part. Another factor for Pakistan for the next few months, or what has panned out is floods. They have created an opportunity, and they have created a challenge for all businesses on ground. uh, Challenge in terms of supply chain issues, challenges in terms of when we can get back to the normal business, and is this the new normal, or is there something else that will change the business cycle. um, so if this is the new normal, then we have supply disruptions coming in, and we have issues coming through. And if this is something that we won't see in the next in another 3-4 years, so there is different thought process all along, because this then creates opportunities, because a lot of rehabilitation activities would work through, a lot of development activities will happen. So this will drive both public sector and NGO investments coming into multilateral investments coming into Pakistan, which will drive the offtake of businesses on ground in Pakistan, especially those that make things in Pakistan. So, like if you look at floods have the people who make tents and these equipments, disaster management, they are right now minting money, because when I say minting money, I don't mean that they are overcharging. I mean that if they were working for one shift, now they have an opportunity, and if they can now operate 3 shifts and create more tents and create more supplies for the flood affected or the disaster areas. Similarly, if you look at the transport industry, with the upcoming recession, maybe in the US and Europe, and how Pakistan sales have substantially slowed down because of higher interest rates. There was a potential that there was an opportunity. There was a potential that the transport industry would actually face a slowdown. But this relief activity is actually causing a lot of is actually continuing to push our oil imports and our oil flows to come through. Um, so we saw some weeks back when the land route between Karachi and then the port and the remaining areas was impacted. Diesel offtake of our refineries was substantially slower. So now that has started to pick back up. So those are the key things or the factors that you can account in terms of looking at the future economic landscape and the business landscape that comes in. If you look if you're looking at discounters and you're looking at interest rate for your hurdle investment, I think another way to look at is look at the market yield curve, the government, the PKRV and the interest rate yield curve. For what I'll do for Umair, I will for the Monday session, I will start with the yield curve that is there, PKRV, on the government yield curve that is there, and we'll price it out, and you can then so that will give you an idea on where the future hurdle rate should be, based on adding on your riskiness for the security. Yes, Firoz.
Thank you, Mr. Muslim. I think that's it for the questions. We have answered all the questions that we have received for today, and let's just call it a day. And we will continue with our topic from Monday in our next session. Thank you so much for your time, and thank you so much for the knowledge that you have shared across the members, the ACC members, with us today. Anything that you would like to add?
Thank you again. It's a pleasure being here, and see you guys on Monday.
Sure. Thank you, everyone, and have a good week ahead and a great weekend. Thank you, Mr. Muslim.